Dear fellow traders, in this video I would like to talk about Dow Jones and how we should trade Dow Jones for the rest of March. As all of you may know, we are going to have FOMC and interest rate decision on March 20th, which is more likely to not having any cut in the interest rate, and the Federal Reserve Chair is expected to talk about uh, not having cuts in the first half of the year and probably expecting lower number of cuts by 2024, which I think market is not going to like. However, so far this market has shown that it can react to any positive or negative data very differently than many experts usually expect the market to behave. Regarding this issue, I'm going to evaluate what would be the best case if we want to take any trade. As many of you know, this is Dow Jones chart in 2024, and this is DIA, which is the ETF for Dow Jones Industrial Average. As you can see it here today, it crossed above its resistance level. So many of you may say, okay, let's go buy, which could be right. And also, it could be a rejection, and then we are crossing below that level again. So if you want to make it very simple and have a directional bet, it's going to be called because of this strong trade, and today it crossed above this. So this is like the simple case. However, there is a chance that we are getting involved in a complex correction if you are looking at ABC pattern followed by another ABC pattern, which could lead to another ABC pattern, and we get back to the lower border of this triangle. This is the same thing for DIA. Having said that, let's look at my forecasting system, and if we are going to bet on volatility instead of direction. So based on my forecast model, we are going to have 12 trading days until March 28, which is the last trading week of March. And we expect at minimum case Dow Jones move between 382 to 397. If we give it to the a sniper option model that evaluate the neutral option strategies, we can see that if you're opening a longest triangle of 388 put or 390 3 call option, in case that the market just move between the minimum case, like the lowest expected volatility, we are going to close this with almost no loss, and we have the chance to get out with minimum profit. However, if volatility tends to be in a normal range, we are going to expect a movement between uh, 379 to uh, 401, which can cause between 91% to 115%. So, having said that, if we are taking this trade, we expect that the price moves to a 401 or 379, and regardless of the direction, we are going to make money. This is very, we have 75% chance of ending in profit, and we have 50% chance of ending with profit between 91 to 115%. If you take a directional bet, this is going to be definitely different. But as many of you know, uh, being on the right side of the market is something, and being exposed to higher than expected volatility is something else. Now, let's see if the highest level of volatility is going to happen. Then the profit is going to be around 200% if you move toward 374, or we are moving toward to 405. In my view, volatility tends to contract and expand over time. This is often referred to as implied volatility expansion and contraction. Let's break it down. Implied volatility expansion. This happens when uncertainty increases in the market events, like upcoming earning reports, interest rate announcement, or geopolitical tension, that all lead to volatility expansion. As investors become more uncertain about the future direction of prices, the price of the option contracts, which are based on the expected volatility, increase. Implied volatility contraction, conversely, when the market is calm and predictable, implied volatility contract. This typically happens during the period of a steady price movement or bullish trends where investors feel confident about the future direction. As uncertainty recedes, the price of option contracts fall. Remember, implied volatility reflects the market expectation of future volatility, not the actual historical volatility. In long term, the option trader who bets on volatility and buys long strangle is generally considered to have a higher chance of success. Here's why. Naked call and puts are directional bet. These options gain value if the market moves significantly in the direction you predict. So this is two factor: significant move in the direction that you predict. However, market can stay flat or move against you, leading to potentially large losses. If market doesn't move and stay flat, it doesn't matter what option you have or which direction you are in, you're gonna lose money because of the time decay. Strangles profit from volatility. Long strangles involve buying both and call for option at different strike prices for same underlying asset and expiration date. The profit is when the underlying asset price experiences a significant move in either direction, capitalizing on increased volatility. But it has its own caveat. It requires larger capital to buy both sides, and also if the market flats, you lose twice. So strangles offer a way to profit from market movement in either direction, while naked option requires a correct directional prediction. Strangles have defined risk, while naked options have potentially unlimited risk if you sell them, but if you buy them, it's limited to the premium you pay. However, there is no guarantee for both trading strategies. In general, if you are betting on directional bet like naked put, naked call, you are going to have less win rates with higher payoff if you don't close it too early or too late. On the other hand, the strangles have higher success rate with lower payoff, which could be beneficial in long term. This was the explanation behind this trade idea. I hope you manage your risk in trading by having enough information. This is not a recommendation to buy or sell, as you know. This is actually a trading idea based on the expected increased volatility in the second half of March. If you like ideas like this, subscribe to my YouTube channel and my Patreon. I will provide the link in the description section.